All right. Hi, everybody. We're just going to give everybody a moment. We have a few people in the waiting room that are still filtering in. So thank you, everybody, for joining. Thank you to people that gave us questions in advance as well, because we will be sure to ask them. Um, and we've got, yeah, like I said, we've got a couple of people still in the waiting room. So we're just stalling for time here as people join. My video on? Yes, it is. All right. Well, today we were going to talk about insurance essentials. So we're just talking about, this is basically supposed to be kind of an insurance 101 and talk at a high level about some concepts, what is life insurance, what's critical illness insurance, and so forth. Um, and and then ideally we'll have some other webinars that'll go into greater depth on these products. We're also really happy anytime to hop on a call with anyone and also go into greater depth as well. So thank you to everybody that's joined us so far. We have this is our team here. We've got Eric and myself as advisors on the team. We've also got Leah, Kashfi, and Joan and they help keep the lights on, as it were. And you've got thank you to Leah for doing all the work to organize this webinar. Leah's sick today, so she's not on for us to thank her, but she can hear us virtually, I'm sure. Today we're really lucky to have Teresa Walkey join us. Teresa Walkey's at Manulife Financial. She's a senior sales director there. And Teresa has a boatload of experience. She's been with Manulife for a long time. I'm not gonna, you can read it there, but I'm not gonna say how long because it's impolite. But Teresa is a very accomplished speaker as well. She's very accustomed and used to talking about insurance. In fact, I was at an insurance conference with Asante last week, and Teresa did a fantastic job speaking there. So, along with all her colleagues that she brought. So, Manulife's a great partner for us on the insurance side. There's lots of great companies out there, and Manulife is one of them. They have a broad range of products and a lot of knowledge, which is we find really, really helpful. Fun fact, Teresa did a mission to Haiti as a volunteer in 2011, so that was pretty formative for her. And she likes camping and gardening, golf. She's a bunch of grandkids. She likes traveling overseas to see some of those grandkids. So life is pretty good for Teresa. Um, and Tell you what, Teresa, I'm going to let you, sorry, as people have any questions, please just put them in the chat or in the Q&A function, whichever you want, and we'd be happy to ask them on your behalf. Eric, did you want to say anything before we throw it over to Teresa? Or you?
Just thank you to everybody for joining. I mean, insurance is a portion, I think, of your overall financial picture that's often overlooked. You might say, okay, I'm working, I'm covered, I've got benefits. So what we want to do today is really give you an expose on what these different insurance pieces are, to give you that knowledge and then ask the question, hey, am I covered? Should we be looking at some gaps? So I'm thankful for Teresa to be looking at that with us. And then we'll also get into some more advanced insurance uses. So this is great. Thanks everybody for joining and hope you get a lot out of this.
Okay, thanks, Eric. I'm going to share my screen.
Awesome.
Let's get there. So this is designed to be an introduction to insurance. As Eric said, it's a financial tool that is not as well understood by Canadians as some of the other tools that we have. So our attempt today is to just give you a foundation of what types of insurance there are, where they fit, and what they do. So I'm going to talk about a number of different kinds of insurance. Some of this terminology may be familiar to you, some of it may not. So we'll talk about term life insurance. We'll talk about Life Check CI. That's the name that we give to our critical illness plan. We'll talk about two permanent solutions. So universal life and participating insurance. We also have a life insurance product that's guaranteed issue. What that means is no medical questions are asked. So that is a solution for people that can't pass the medical questions to get into the regular stream of products. And we do have a special thing going on at Manulife called Vitality, which I'll share with you a little bit as well. I find that when I've been talking to people, this slide has helped. And what we're trying to do on this slide is kind of paint a picture for you of which types of products fit at different types of stages of your life. So age is along the bottom axis. You can see we've run it from 20 to 85. Typically, that's the years that people buy insurance, although we do write insurance on people as young as 15 days old and as old as 90. But the products vary. So for sure at Manulife, we have all of these things. We have a health and dental plan. So think of that as medical insurance that covers you for prescriptions and dental care and things like that. Travel insurance, that again, we put the line on, that can happen anytime in your life. I hope we all get to keep traveling. And that's typically a plan that covers you if you have an emergency medical situation pop up. Travel insurance is never intended to cover you for regular medical issues that you knew you already had. Critical illness insurance is a different animal. It's one that pays you a lump sum, one payment if you are diagnosed with a critical illness. And there's a list of 25 things that we cover in this product. The most common ones that you would be familiar with would be cancer, heart attack, stroke. Those are the big ones. Then we move up a layer and we look, I would divide this slide into two pieces. If I look at the left side, so in your working years or in your earlier years, you would be concerned about making sure that if you can't work, there's still income coming into the house so that your bills can continue to be paid. That's disability insurance. So disability is measured on being unable to work and being under the care of a physician. Often, Canadians' first view of insurance is mortgage insurance. So mortgage creditor just means it's offered by the bank in connection with your mortgage. That does the same job as term life insurance, which we sell on the insurance side of the business. You have a choice when you have a mortgage of either buying term life or buying mortgage insurance through your bank. At some time in your life, and you can see we built these to kind of taper off, your long-term disability insurance need is going to disappear. Typically, that lines up with when you stop working, and long-term care insurance kicks in. Long-term care insurance is insurance that pays you when you're unable to function on your own, and that can be physically or mentally. The sad news in Canada is that almost all the insurance carriers have discontinued selling this product because people didn't want to think about it until it was too late. But there's other ways to accomplish covering that risk later in life. And above that, you see a big blue band, permanent insurance. So that's life insurance also. And it's what I would say kicks in after term insurance. So term insurance is what you use when you need a lot of coverage. You've got a lot of expenses. It's typically, I've got a mortgage, I've got young family, all have to be looked after. And then very often what we tend to do in Canada is say, oh, gee, the mortgage is done. The kids are grown. I don't need insurance anymore. That's when permanent life insurance steps in and is a hugely powerful tool for both retirement planning and for estate planning. And I'll share a little bit about that as we go through this presentation. So this is just a graph of what fits where. Now, of course, knowing what type of product might be applicable for you based on your age is just one part of the story. The bigger part of the story is, am I going to make a decision to buy this? And when I think of this, I think of the story of walking into an electronics store. You can't walk out of that store, go through the cash register without them asking, do you want the warranty coverage on this? And sometimes, if you're like me, we say yes, and sometimes we say no. What goes into that decision? It's usually about, is the problem that they're trying to give me extra coverage for likely to happen? If it does happen, how expensive is it going to be for me? And can I solve it on my own? And that's the same kinds of questions we ask with life insurance. It's about, is it likely that I'm going to pass away? Well, guess what? That risk is 100% over your whole lifetime. It's probably less in your early years because the average life expectancy in Canada is in your mid 80s. So usually your 30-year-olds aren't worried about passing away, but we do know that if it happens, it's not recoverable, right? Yeah, it happens, it's over. So it's a big risk from that perspective. It typically has big repercussions for your financial plans. So that's why to me, in the insurance industry, I go, this is a valuable tool. This is something you want to have added to your financial plans. So then you work with Eric, you work with Per, and you go, how much do I need? And we have calculators that can figure that out. Sometimes it's about how big is the mortgage? How big are my other debts that I want to wipe out if I pass away? And and those are about letting the survivor continue the kind of life they currently have. Um, Most of us in our early years, when we're talking about mortgage and debts, they take both partners' incomes to work. So if one partner is suddenly not there, the other one is going to need some help, or they're going to have a dramatic change in lifestyle. And the last thing you want to do to a family is have them have to move because somebody's passed away. So that's what this is here to do. So there's calculators that will calculate out how much do I need to cover those debts? How much do I need to replace the income of the person that's gone? What other things were we saving to do together that I can't save on my own to do? And the biggest one in that category is typically education for children, post-secondary education for children. So a needs analysis is the big step. And I would say when I look at this, I go, make sure you get the right amount. Make sure it's the right, oh, look at that product. I didn't spell that well. The right product, the right amount, and the right type at the right time. So a lot of rights to carry on for. So let's just take a quick peek at each of those products an attempt. So what is term? What is term insurance? Well, term insurance is the clue is in the word. Term is short for temporary. It's temporary insurance. It's not designed to last your whole life. It's designed to last for a short period of time. And because it's only designed to last for a short period of time, it's much less expensive than a plan that would cover you for your whole life. So it fits for people who have limited budgets for insurance because it's less expensive. It fits for people who need a lot of insurance. So think of this as your early stages of life. You've got a mortgage, you've got other debt, you've got children to raise, you've got all kinds of demands on your cash flow. So you need a lot of insurance if something goes wrong. It's also good for people who may have a need for insurance now, but that may disappear. So when I think of clients who have businesses, I would think of, oh, someone who has an operating loan. Maybe you're only going to have that for a short period of time. So you cover that loan while you have it, and then the need for that insurance goes away. So the thing to remember here is term insurance is temporary and it's less expensive because it's temporary. Now, what does temporary mean? Well, it can last out to, you see here a term 10, a term 20, a term 65, a term life. That just means for 10 years, the price is going to be the same and then it's going to change. or for 20 years, the price is going to stay the same and then it's going to change. And when I say it's going to change, it's going to go up. The longer it has been since the insurance company has looked at your health, the bigger the risk to us that your health has changed. So that's why after the first 10 years in a term 10 product, your price will go up. And the same in a term 20. A term 65 is designed to just last your working life. So it goes till age 65 and then it's done. A term life product, sometimes called term 100, lasts essentially for your life. And you can see the kinds of ages that we would issue this kind of product on. So everybody starts at age 18, except for the term life. You need to be a little bit older to get into that. Now, you can buy an insurance product only on yourself, or you can buy it on yourself and your partner. When you're buying it on yourself and your partner, you can buy it so that it's designed to pay out when the first one of you passes away. So at Manulife, we call that combined, or sometimes it's called joint first to die. Or you can buy a plan that's designed to pay out only when the last of you passes away. So why would you need either of those? Joint first, obviously, is for people who need the money to show up when the first person passes away. So that's typically for people that want to wipe out a mortgage, they want to set up an education fund, you want to wipe out some debt. So that's family protection mode, or covering a loan at a business. Joint last is the solution that we bring into play when we're doing estate planning and we're saying, wow, I've really listened to Eric and Pear. We've done well. Now it's about protecting my assets, but I know that when I pass away, there's going to be a tax bill. And insurance is bought by many, many Canadians to help pay that tax bill on a way more efficient manner than just saving for it on your own. So that's joint last. One of the things that's interesting, I said that we have a plan that pays out when the first person dies. Typically in Canada, when the first person passes away, the plan is over, but the survivor has the right to go back to the insurance company and say, can you write me a new policy? Because I still have a need. But the insurance policy company may ask for medicals, or they may give you a really tight time limit that you have to come in and talk to it about. We didn't like that at Manulife. We said, I don't want to force anybody to come in and have an insurance conversation just shortly after their partner has passed away. So what we do is we say, yes, we're going to pay the first person when the first person passes away, but we're going to automatically continue the same amount of coverage on the person who is surviving at the price that they paid way back when they started the plan. So a really powerful, we think, nice thing to do to make it a little easier for you. Sometimes when the plan changes at what renewal points, remember I said at year 10, the price changes, or year 20, that's called renewal. So your plan, you want to buy a plan always that has renewal as a contractual feature. You don't ever want to be in the spot where you've bought a plan and by the time you get to year 10, you have to start all over. So this one, when you renew, there are two ways that an insurance company can do it. They can either set the price for what they think they need for the whole next 10 years, or they can set it on a way that goes up gradually. We've chosen the latter. It goes up gradually. Terminology on that, YRT just means yearly renewable term. And it just means less sticker shock for you at that renewal point. So a kinder, softer path. If I need my coverage, I thought my mortgage was going to be done in 10 years and shoot, it's going to be 12 years. You can let it ride. It'll be fine. So just another way we've tried to be a little bit more innovative. One of the other things that we found is it is quite common for people who have bought coverage to say, oh, you know what? Like I just said, the mortgage is going to be done in 10 years and it's going to be way longer. Or, gee, I bought I bought the next level of house, and guess what? It's a new mortgage and it's bigger, and I'm going to need coverage longer. At Manulife and at many of the carriers in Canada, your contract on the life insurance side will have a provision that says you can switch to a longer term. So switch from a term 10 to a term 20 if that's appropriate for you. So this is another feature that if I was looking at a policy for you, I would say you need to pay attention. Is it renewable? Can I switch to something else if my needs change and I need to change the model? So yes, you can do both of those. The other thing that we've built into our plans is a conversion rate. Think of term insurance as your first step into insurance, but it's a foundational step. So what we like to do at Manulife is say, I only want to review your medical once and let you have a plan that can grow and change with you as your life changes and your needs in your life change. We call the process of taking that term policy and coming into the insurance carrier and say, oh, you know what? I now want to, I don't need to use it for the needs I originally started with. Now I want it to be an estate tool or a retirement tool. Well, that means you're going to go to a permanent plan. You need a plan that's going to last as long as you do. That's called conversion. So conversion is the process of taking the kind of coverage that you were given for when you first applied and saying, change it from a term policy to a permanent policy. And at Manulife, you can do that right up to 5 years before the policy expires. So for most plans, the term plans expire at 80. You can do it up to age 75. I would caution you that the older you get, the more expensive insurance is, because statistically speaking, you're closer to the time where we might expect you to pass away. You can convert at Manulife, just part of it, and have the rest of it restart as a new term piece of coverage on the permanent plan. That's called a partial conversion. So that's a nice step if you decide you don't need as much coverage as you started with, but you do need some permanent, but you still need some term also. So it's a nice way to have a little bit of each. Now, when I was talking about this little overview with Per, he said, you know, can you talk about some unique little features that are there that Canadians have really liked? And one of them is we have a feature you can add to your term policies called a child protection rider. So it's insurance on a child. Obviously, a child isn't statistically likely to pass away in the early years, but if they do, for some families, just covering those final expenses, the funeral costs, etc., can be a bit of a challenge. So there's a $10,000 death benefit to this to look after that. Heaven forbid that should happen. But the bigger thing is that it comes with the right to buy more insurance on that child when they turn age 25, and to do so without having to ask any medical questions. So we call that guaranteed insurability. And I would say when my children were younger, I bought this on them. And at age 25, we used this provision to automatically guarantee them, no matter what health issues they might have developed. They didn't, but if they had, they would still be able to buy permanent insurance. So it's a nice thing to do for children, to kind of give them a head start or a guarantee that they're going to be able to use this fantastic tool. So I would say if you are looking for insurance that is low cost, that you only need for a limited period of time, then term insurance is the tool that you should be looking at. And most often that's mortgages, it's loans, it's looking after a family in case one of the people passes away. So I hope that kind of clears things up on term life insurance. You can also buy critical illness insurance, and it's totally different. If you came in and asked us for both term life insurance and critical illness insurance, the underwriter, that's the person that reviews your health to see if you're considered a good risk for the insurance company, would ask and look at different factors in your medical history to determine whether they liked you for critical illness as opposed to life insurance. Let me explain why. Most people who are diagnosed with cancer, heart attack, stroke survive. They have a short-term problem, a significant one that often has big financial ramifications, but most people survive. So it's not a life insurance risk, it's a critical illness risk. And critical illness can also have term or permanent coverage to it. So there's a term 10, there's a term 20, there's a term to 65. And we consider the level to 75 or the life plans permanent. What do they do? These things are available from age 18 up. Your coverage typically goes for most of the plans to age 75, but the term life does go to age 100, which is powerful. If you think about planning for your retirement and you think you're going to live a long time, the amount of money that you'd have to set aside for retirement, if you assume you're going to be healthy the whole way through, is different than the amount that you would set aside or build your retirement plan to be if you wanted to put a cushion in there for the chance that you might have a critical illness, so a cancer, a heart attack, stroke, which might all of a sudden change where you live, what kind of help you need, whether you need assistive devices. So all of those things. So that's why there is a permanent model to critical illness insurance. It pays for 25 conditions. So I keep mentioning cancer, heart attack, stroke because those are the biggest ones. But there's also things like blindness, deafness, loss of sight, loss of limbs. So accidental injuries that are significant are also covered. Think of it as a medical event that changes your life. Now, when we looked at this, we also found there are some medical conditions that change your life, but just temporarily. So we do have a feature on these plans that says for those conditions, and we've identified 6 of them, and you can see them here on the screen, we'll pay you a partial benefit out of your plan, and the plan will continue on, and you will still be covered for all those other 25 conditions if you progress to that, or even if you started with so let me pick on ductal carcinoma in situ in the breast. That's a breast cancer, an early stage breast cancer. It's recoverable, but it is impacting. So we pay a part benefit for that, 25%. If you had a $100,000 policy, we would pay you $25,000 if you were diagnosed with that. You'd still have coverage for $100,000 if something else happened to you in your life. So it's a great way to get coverage for both of those kinds of events. And there's my little example. I stole my own thunder. So a little example, Kara, 32, aged 32 female, purchased a level to 75 critical illness policy, which we call Life Check, with ROPS. ROPS means return of premium if she gives up the plan, if she surrenders the plan. She's bought for $100,000. Several years later, she's diagnosed with ductal carcinoma in situ. She covered the treatment successful. She does well, but all she has to be is diagnosed to get this benefit. This whole critical illness insurance works on diagnosis, not on whether you recover or how fast you recover. It's about were you diagnosed. So she gets $25,000. And she still has $100,000 of coverage for everything else. But at age 50, she decides, I don't need this anymore. She cancels the plan and she receives the amount of premiums that she's paid back, less the $25,000 that she already received under the early benefit. This plan, our critical illness plans also have a living care benefit. So remember when I said early that insurance plans, there's an insurance plan that covers you when you're not able to look after yourself, called long-term care insurance. This is the way that we get at that at Manulife. We made it part of our critical illness policies. So in addition to the 25 conditions, you also have a benefit in there that says, regardless of what causes it, if you're not able to look after yourself anymore, we will pay you 1% of the amount of insurance that you've bought if you are at home every month. So if you're at home, you could get up to $5,000 a month out of this plan. Depends on the size of your policy. So if you've got a $500,000 policy, you would get $5,000 a month. If your condition progressed to the spot where you needed to move into a facility for care, so a long-term care facility, we would double that up. So all of these plans are about protecting the assets that you've built, because you could pay this out of pocket, but you'll find that this creates a much bigger pool of resources for you for those situations. The two kinds of situations for this are being unable to function physically or mentally. So physically, it would be you can't do 2 of the 6 activities of daily living. Daily living, it's easy. These are the things we do every morning when we get out of bed. We get out of bed. So that's transferring. We bathe, we get dressed, we toilet, and we're able to feed ourselves during the day. And we're also able to maintain continence during the day. So those are the 6 activities of daily living. If you can't do that for 90 days, you'd qualify. The other way to qualify would be being mentally incapable of looking after yourself. So dementia, Alzheimer's, other conditions could lead to this. And again, if you're unable to look after yourself for 90 days, you've met the criteria and you would get a claim. So an example, here's Gwen. She bought $250,000 of coverage. Her contract goes to age 100. At age 80, she falls down the stairs and suffers some serious hip and leg injuries, which means she can't do 2 activities of daily living anymore. She can't bathe and she can't transfer on her own. She qualifies after 90 days for $2,500 a month. So there's that 1% number. And the amount of coverage in her plan is reduced by each payment coming out. So think of it like a bucket of money. That's why I've got the term bucket up there. And if she moves into a home, we would double that up to $5,000 a month. And we'd keep paying that out until she uses up her whole coverage amount that she bought initially. So she could do that for 40 months, a long time. So who should be considering critical illness insurance? If we look at statistics, every Canadian is more likely to suffer a critical illness and a disability in the younger years of their life than they are to pass away. So I would say it's a good idea to have all those 3 pieces in your financial plan to protect what you're building. So that's critical illness insurance, which pays you on a specific condition being diagnosed, life insurance, which pays you if you pass away, and disability insurance, which we haven't talked about yet, which is a plan that covers you if you're unable to work. So it's not as severe a state of incapacity as what we've talked about with the long-term care. Let's turn the page to permanent insurance. And this is where I would say we're going to step into a conversation about the things most people don't know that insurance does. So permanent insurance is life insurance that lasts as long as you do. And it does a different job than what term insurance does. Because it's not about paying off your mortgage or your other debts. It's about a different kind of asset that has some pretty good attributes. I mean, the government has given insurance, permanent insurance, the right to accumulate money on a tax-free basis and to pay it out tax-free at estate time. So think of it a little bit like how your TFSAs would operate. You know, everybody loves TFSAs and they love them because you put money in and it grows tax sheltered. And then it comes out, you can name a beneficiary. Same thing with life insurance. You can put money in, it can grow tax deferred, and at estate time, it becomes tax free because you name a beneficiary and it pays directly to that beneficiary. So you'll see on screen here, I've kind of said I have some advisors that I work with that call it their third TFSA for a family. So each of you has your regular TFSA. You've maxed that out because the contribution limit is, only 7 grand. And you're looking at it going, I have some more money that I'd like to have in this kind of tool. That's insurance. That should be your pivot to insurance. Insurance has the same kind of tax attributes, but higher limits. There still are limits. The government knows they're giving up tax dollars, so there still are limits, but the limits are much higher than TFSAs. It's also a really permanent life insurance is also being recognized and is used a lot by families and businesses who want to pass wealth on efficiently because you can buy a policy. I have a lot of grandparents, parents who say, how do I pass money on to the next generations efficiently, tax efficiently? And the answer is insurance. Like you buy an insurance policy on a child that costs almost nothing because they're not likely to pass away. You fund it up as the parent or grandparent. And then later on in their life, instead of you owning it, you pass it on to them and say, there it is. There's your retirement tool or your estate tool because it's grown in value. The second thing that people are using permanent life insurance for is to pay final taxes and other expenses. In Canada, we have this lovely thing when we pass away that the government says, I'm going to do a tax calculation on you, and we're going to pretend we've sold everything you own the day before you die, and all your registered savings that still exist are going to be treated as income for the year. That can create a surprise, a tax bill for a lot of people. And so once they're aware of that, we see them coming to us and saying, hey, I need a tool that will pay out right then to pay that tax bill so that what I've saved can pass on to my beneficiaries in whole and not be depleted by the tax bill that would have to be paid. Another one is keeping the cottage. Like a lot of people, the cottage is one of those things. It's typically not a principal residence, so it doesn't have the principal residence exemption. So there's a tax bill on that when you pass away. So a lot of families will buy an insurance policy to do two things, pay that tax bill, and sometimes also set up a maintenance fund for the cottage on an ongoing basis so that the next generation, which may not be as well off, has money to look after the cottage. In a corporate context, gee, that's a whole other presentation. The lovely thing about purchasing a policy inside your corporation, if you happen to have one, is that an insurance benefit paid to a corporation also gives that corporation a capital dividend account credit, which is capital dividend is a tax-free dividend out of the company. So it's about making sure that the insurance dollars actually end up in the end hands on a tax-free basis, which is what they do on the personal side as well. Powerful tool. So two kinds of permanent insurance. One is universal life. So universal life, think of it as a permanent insurance plan. You could almost call it buy term and invest the difference in one plan. It's insurance and investments in one plan. And you get to choose the investments from a set that the insurance carrier has defined. So like every investment, it will go up and down with the markets, and you will feel that up and down as it happens. We do have, because we found that people that invest in a universal life product sometimes are so busy focused on their regular investments, they forget about managing the investments inside their insurance plan. So we have built investment options inside that are self-managing, that you don't have to manage on a day-to-day basis. And I've highlighted one here. It's the gold account. That's the name we've given to it. It's kind of a balanced account that has a very low management fee. So you have options depending on who you are, what your investment profile is. You can pick a mix that fits for you. The only thing that I would say is in these permanent insurance plans, like term plans, like almost anything we own in our lives, there's a payment that's due every month. So remember that. You don't want an investment that goes dramatically up and down to the point where maybe it's down at the time where we have to pull the monthly costs out, because it's a little hard to recover when the money's gone. The neat thing I would say about our universal life plan at Manulife is that A, the money is growing tax sheltered. B, it actually has a better management fee structure than you can typically get on the outside. So if you're invested in any mutual fund on the outside, of course, you pay the mutual fund fee to the mutual fund company. That's a retail fee. Manulife is not a retail investor. So when we are buying these assets to link it, we're not paying the retail fee. So we're not going to charge you that fee. So the simple way to explain it is you can see on managed accounts at the side there, plus 1%. So if the management fee from, we've used Manulife Fundamental Equity Fund, if the Manulife Wealth side of the business would normally be charging 2.24, we're only going to charge you 1.24 inside of the UL. So tax deferred and a lower management fee. So pretty attractive story. The gold account, as I said, is that hands-off account. We define the mix. It's kind of a 55 to 60-40 kind of mix, 60% fixed investments, and the other 40 is split kind of 20-20 equities and real estate. So it's designed to be, you know what? It's designed to be boring. It's designed to perform like a balanced account with not a lot of risk. So UL, the permanent insurance type called Universal Life, would be attractive to you, would be a good fit for you if you want to see all the moving pieces, because you can in these products. If you wanted to define your own asset mix inside the plan, then Universal Life is for you. There are people who say, you know what? There's enough work managing my investment pool outside of insurance. I want my insurance to kind of manage itself. For those folks, Manulife Par or whole life insurance is the way to go, because the investment fund is defined by the insurance carrier. So regardless of which insurance carrier you go to, if you're buying the whole life plan, the Par participating plan, you're buying into a permanent product where the carrier defines the asset mix, and it's designed to be stable, usually about a 60-40 mix, more heavily weighted for sure to fixed investments. And you can buy these like you can buy term with different pricing structures. So you can buy one where you only have to pay for 10 years. You can buy one where you pay for 20 years. You can buy one that you pay to 90 or pay to 100. The interesting thing about these whole life plans is the name I used was participating. You are kind of like a business owner in this little piece of the business of the insurance carrier. So you participate in whether we've priced it right. So and you get a piece of the investment earnings, and it all creates a dividend. So that dividend each year is going to buy you more insurance in the plan, and it's also going to increase the cash value of the plan. So whole life plans always have a cash value that you can use during life if you need to. The death benefit also grows. And there are lots, the things that we see this used for are an estate tool where I've got an estate need that is this big now, but it's going to grow to this big, right? It grows because these plans grow. The dividend that they pay annually makes them grow. If you are someone who wants an estate tool, but you want it to have value during your life, just in case, who knows what happens, then PAR makes a lot of sense to you because would make a lot of sense to you because it has a cash value always. In more advanced strategies, there are people that use that cash value as collateral for a loan that they use to help give them extra income every year during their retirement. We call that an insured retirement program. Or we have people who even take it another step farther and say, take it to the bank immediately after purchase and leverage it, saying, okay, I want all the cash value back because I'm going to use it in my business. So it's kind of a have your cake and eat it too situation. One of the interesting things at Manulife is that all of our permanent plans also have something written into them called the disability benefit. So it says, if you own one of these plans and it has cash value and you become disabled, you may withdraw the cash value without any tax consequences. So that's pretty powerful. If disability coverage is not something that you have, you can kind of let this plan do that job as well. The caution I would give you there is that, of course, if you're pulling money out of the plan now during life, it's going to impact how much is left for estate time. So that's what we call the disability benefit. The other thing that's very flexible at Manulife is how much extra money you can put into your plans. Some carriers are really tight on the rules on how much extra you can put in and when you can put it in. We've done some extra analysis on that and have decided that if you're approved to put in extra dollars, you can put them in at any time, subject to the tax limit that the government sets, of course. But you can be approved for it when you buy your policy and not do it for 40 years. Do it 40 years from now. We don't care. So I'm just going to skip past all the big detail on this slide and just say, just think about, the deposit option can be flexible. I mentioned that there's a dividend paid on these policies every year. For us, we announce what that dividend is going to be each year, usually in late June, early July, and it holds for the whole from September to August. So remember I said in a UL, you're going to feel the ups and downs. You feel the performance of the market as it happens. In a whole life plan, you don't. We watch it for a whole year and set the rate once a year for you. So it's more stable. So PAR, whole life, is probably a good plan for you if you have a need that's going to grow. If you have an insurance need at estate time, but also want to have a plan that's got cash in it during your life, in case you need it for something during life and you can withdraw it or leverage it or take a loan against it, any of those things. So different tools for different folks. I will go now and say not everybody's eligible for insurance. There are some folks whose medical history is such that they're just not eligible for insurance. We do have a product for those people. It's a guaranteed life insurance product. It's available up to 100,000, so it's not going to give you millions of dollars of coverage, but it's going to give you some coverage. And there are no medical questions at all on that one. So options for everybody. I'm going to skip past all the big details on that one and just say if Per and Eric will work with you, and the first step should always be to try to get into the regular product stream and go to this only as necessary because you do pay a much higher price for a product like that, regardless of where you go. The last thing I wanted to mention to you is that Manulife has struck out on a new path saying we don't just want to be the insurance company that pays you when the wheels fall off the bus. We know a lot about health, um, and and we'd like to help you stay there in health. I think if I asked all of you on the line, has anybody ever had a New Year's resolution where they say, I want to be healthier this year, so I'm going to watch what I eat, or I'm going to move more. And guess what? January 2nd comes along and we've already broken our things. So what we know is human nature is that if you get rewarded for doing something, you typically will keep doing it. So that's what this program's all about. It's a health and wellness program where Manulife says, if you tell us you're doing something healthy, we're going to give you rewards. And we've had a whole bunch of other companies jump on board with us on this because they say, yeah, we want to be part of that. And you can see a couple of the names here on screen: Apple, Garmin, Fitbit, Orange Theory, Good Life. Exam One might not be as familiar to you. They're a medical team of nurses that will come to your home and give you a medical test. Amazon, Expedia. So all of these companies have stepped up to join with us in an effort to help people stay on a healthy path. There's also insurance savings as part of this program. So you do pay a fee for this program, and then you do get rewards from it, both from those partners, but also as a discount to some of your insurance costs. And we're finding, we've been at it for 9 years. Next year's our 10th year on this. We're finding that people are loving it. There's two versions with us. One is called Go. No fee for that one. The number of benefits that you have in it is smaller. And Plus. Plus is the one with all the big reward partners in it. It's a points program. You get points for doing healthy things. So walking, if you go to the dentist, go to the doctor, all of those things count and you earn points. And the number of points you get in a year defines how much of a discount you get on your term or UL the next year. It also defines how big your rewards are from all those other partners that I mentioned. So we love it. We're finding the people that are in the program love it. 50% of them are at the highest levels. And, I know I've seen a Peloton commercial at one point where they said, 96% of our people actually get on their bikes and get moving. Well, our version of the Peloton commercial is 97% of the people that ask to have this added to their insurance plans with us get on and get going. So it's a game changer. A lot of people don't think insurance is fun. This is our way of trying to make things fun. And don't we all want to live longer and healthier? So if that's you, then when you're talking about your insurance product solution with Eric and Pear, make sure you ask about Vitality as well. So that's a quick cruise through insurance. Pear, I'm going to turn it back to you. And
All right, thanks, Teresa. That was really great. We do have some questions, not surprisingly,
okay,
and I'm
right.
just gonna pull up our questions slide, and I'm gonna replace your share. Press this button. Okay, there.
I'll stop sharing.
Yeah, sorry, Leia's sick, so I'm trying to do my best to replace her.
You're
And
doing real well.
right. So few questions here. I'll give you a couple of softballs to start with. Can the beneficiary of a life
Okay.
insurance policy be a minor? So under 18. Not a gold minor, but
Yes.
well, they can actually, but anyway, that's a whole other story. But we're
Someone
talking about
underage.
can they
Yes, they
still at 18?
can,
Yeah.
but it's like anything. You'd need to set up a trust to manage the proceeds for them. So
Yeah.
we often have people who say, I want this policy to benefit of my children who are minors, and the trustee is X.
Yeah. And that's all done through the insurance policy. It's really easy. So what
Yeah.
we do there is simply you come to me and say, listen, I'd like my grandson who's 10 to be the beneficiary of this policy, no problem. And then we put maybe mom and dad as the trustees of the policy. And that's all done at Manulife's end. And then hopefully that never gets paid out. But if it does, then mom and dad would manage the money for your grandson until they turn 18. So that's totally solvable. Um,
Yeah.
where do people typically, and I'll ask you a harder question. Oh, sorry, another one. Does it make financial sense to purchase a critical illness insurance policy after the age of 75?
Oh, great question.
And I
Yeah,
would say
our
yes,
risk
but
of cancer,
yeah,
yes, but yeah, our risk of cancer, heart attack, stroke doesn't end. So when you're doing your planning for retirement, I would say building a buffer for the instance that health is going to not be perfect. Because life insurance plans are not available after 75. Age 65 is the oldest. And
yeah.
some care, like we even,
So you mean critical illness? You mean critical illness plans are not available after
correct,
65?
correct.
Yeah, yeah, okay. Just to be clear, life insurance plans are available. They're
Yes.
available. They can be pricey, but it's totally doable. But critical illness, not, sorry, no. That's so we like to use tax-free, if you're over 65 and you say, geez, I'd really like to cover off risk of cancer, whatever, stroke, all the different one fun things that people can get. That's where we like to build up your tax-free savings account. And that's a great place to self-insure essentially. But unfortunately, yeah, it needs to be set up before age 65. Um, what else? When people are looking to get, let's say, a life insurance policy, where do they tend to fail? Is it in the underwriting, exclusions, misunderstandings? Where do we typically see problems crop up?
Um, when you apply for a life insurance policy, there's two kinds of review you go through. One is medical and one is financial. I find, or we find, that more people think they are ineligible for insurance medically than actually are. Like we write on people, 6 months after a heart attack. We write on people with cancer. It depends on the cancer, but usually within 2 years of the end of treatment. So there's more people eligible for medical insurance, life insurance, than think they are. Um, what would be a common failure point? Someone that's still going through is in the middle of cancer treatment, probably needs to wait till that treatment is done.
Yeah, I
That
even
would be a
find
good
I
example, I
agree.
guess.
Another one is, even if your doctor has said, listen, you had this test, it's probably fine. It's a little bit abnormal. Come again in 6 months for another test. That typically will mean that the insurance company will want to say, well, let's just see what that test says in 6 months, right? And there are some
Yeah,
products we can get you. There's the guaranteed issue that we can get you to cover while you're waiting if you really have a need, or if you can wait, you just wait to get that test done and then rule out whatever it is that the doctor is monitoring. Um, we covered off, permanent insurance is pretty interesting, in terms of it's a slightly different concept than just, term insurance. I like to think about that as car insurance. As long as you don't crash your car, you don't get paid. Same with term insurance, you have it for a while while you have kids and mortgages and stuff. And as long as you don't die, nothing happens and you just pay that premium. And at the end, you lose, all that money was just there to help you sleep well. Very useful, particularly when you have children or mortgages or some other really insurable immediate need. But long term, it's not the same. So you covered a little bit about the purpose of whole life insurance and permanent insurance, such as universal life, which I think is great. Um, and I'm going to talk a little bit about somebody that's in their kind of, middle-aged and then somebody that's a senior. So somebody in their 50s, for example, they've built assets. But what's the most efficient way for them to use insurance today?
What we find is thinking about planning, financial planning is a little bit like going to your physician. There's no one solution. Professionals like Eric and Pear will ask you questions to determine what are your goals, what do you want to see happen, where are you now, and what do you need to get there.
Yeah.
And it part of that's investments, part of that's insurance. Um, I like to think that insurance's role is to help you keep what you've saved, right? Part of your financial plan is get the assets and then it's keep the assets. And I'm kind of in a keep the assets position with the insurance products. So 50-ish is an awesome age to buy permanent insurance because, as I said earlier, insurance does get more expensive the older you get. We sell a lot of policies to people in their 70s who have suddenly figured out they have an estate problem. But gee, if you can do that in your 50s, way much, much better.
Yeah, and that leads into then the other question is, if I'm now in my 70s and I've built up a nice little real estate portfolio of some rental properties, maybe a commercial building, a cottage. Well, we all know what happens there is over the long run, Canadian real estate goes up. I don't know, year to year, but definitely if, 20, 30 years later, it's gone up quite a bit. And suddenly
Hmm.
your kids are faced with the capital gains problem. And we've talked about this on other webinars where, you have this problem where I'd like the kids to keep the cottage and I'd like to keep them to keep the rental property downtown, but they're going to have to pay hundreds of thousands of dollars in capital gains tax on my passing. And often the kids don't want to front that or what have you. And so, how does insurance fit into that picture?
Oh, insurance is a great tool for paying that tax bill. Because, the way estate law works, you can't distribute assets until the tax bill is paid. So, having the insurance, which pays out at the time you pass, be there. It's liquid money. It's available at the time it's needed. It typically costs much less than $1 for every dollar of tax bill you're going to have, as opposed to saving it yourself. So it's more efficient. It's perfect timing. And it has become quite a valuable tool in Canada for paying those tax bills so the rest of the estate can pass on without requiring a sale.
Yeah. And I mean, going back to the difference between someone in their 50s or 70s, I mean, obviously, when's the best time to plant a tree? 20 years ago. When's the second best time? Now, right?
Yes.
So,
Yeah.
look at it. And then another question on, okay, so now let's say my family member passes away. How and everything is, all normal. They pass away old age,
Yeah.
everything as one would expect. How quickly can the beneficiaries get the money from the life
Depends
insurance
on the
policy?
size of the policy,
Mhm.
for sure. But some of them are weeks.
Weeks, yeah. Yeah. Yeah, I've seen it turn around pretty quickly, 30 business days at
Yeah.
most, usually. It's pretty straightforward. It's mostly just about collecting the data and filling out the forms.
Hmm.
And and everything's paid electronically these days, which is really great. So,
Yeah.
yeah, well, very good. Critical illness can sometimes take a little bit more time because they need to go back to the hospital and get, if you had a heart attack, for example, you survived, everything's fine. But sometimes you have to go back and get some records from the hospital, and the hospital can take their sweet time in doing that. So, because the Canadian healthcare system, as you know,
Yeah, they're busy looking after patients. So
yeah, or in the records
we ask
department,
them for
yeah,
documents. We're not
yeah,
first in line.
yeah, they throw the money at the doctors, not the record keepers in the basement. So,
Yeah.
yeah, okay, great. Well, that's been great. That's I don't know, Eric, if you have any questions you want to throw in, but maybe you want to wrap it up for us, Eric, and
Sure, I mean, one more, and then I'll
yeah.
wrap up
Yeah.
for everybody. Teresa, I mean, in your experience being on the insurance side, is there any learnings as to what the most maybe overlooked risk or an area that doesn't get maybe the attention that it deserves when we look at all of this mosaic of insurance available?
Oh, that's a great question. I find that most Canadians understand insurance as a protection tool, and especially in young families for mortgages and looking after family. Um, the use of insurance as an estate tool or a retirement tool is much less known. And even more less known is the value of an insurance policy inside a corporation for asset diversification that's tax efficient, but also for tax-free transition of money out of a corporation at estate time. Uh, many clients, I don't know how many of your clients are corporate on the line, but there's a lot of small corporations who are suffering from what we call trap surplus. It's too expensive to pass money out of a corporation because of dividend tax if you don't need it. So the inclination is to leave it in the company.
Mhm.
But guess what? Got to get it out sometime. So insurance actually does give you a tool for doing that efficiently at estate time.
Yeah, and there's other methods with the insurance in your corporation to get it out actually earlier. But if you ever watched that TV show on TV Ontario with Hammy Hamster and GP the guinea pig, they always finish with "That's a story for another time." So,
Yeah.
Teresa, I think we'd look forward to. I definitely know you've got a presentation geared up for that one, maybe in a few months for us. That'd be
Yeah.
really good. Yeah,
Yeah.
yeah.
Well, on that note, wanted to thank Teresa for taking the time today, Per, for bringing this to light, and to all of our viewers and listeners. If this has piqued an interest, I would urge you to at least have a look at your own insurance mosaic, see if you're covered, and if you don't know where to start, send Per and I an email. We'd be happy to walk you through that and just show you the gaps and show you where there are risks and opportunities. And this is a really great time to do so. So on that note, I want to thank everybody for participating today. It's an important piece, and if you take care of it now, you hopefully will not have to uh, need it down the line. So urge everybody, take a good, strong look at this. The weather's getting nice, so might as well get this done before summer arrives. And then with that, I wish everybody a great rest of the day. Thank you all for joining.
Thank you.
Thanks, Teresa. Thanks, Eric.
You're welcome. Bye.